Ladies and gentlemen, good day and welcome to the Q3FY22 Earnings Conference Call of Krsnaa Diagnostics Private Limited, hosted by DAM Capital Advisors Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Nitin Agarwal from DAM Capital Advisors. Thank you, and over to you, sir.
Thanks, Margaret. Good evening, everyone, and a very warm welcome to Krsnaa Diagnostics Q3FY22 earnings call hosted by DAM Capital Advisors. On the call today, representing Krsnaa Diagnostic Management, Mr. Rajendra Mutha, Chairman, Ms. Pallavi Bhatevara, Managing Director, Mr. Yash Mutha, Executive Director, and Mr. Pawan Daga, Chief Financial Officer. To start with, I will request the management team to make some opening comments, and then we will open the floor for questions. Yash, can you please take over the floor, please?
Sure. Thank you, Nitin. So, good evening, everyone, and welcome to Krsnaa Diagnostics' third quarter and 9 months ended FY2022 earnings call. I hope you and your loved ones are staying safe and healthy. We have already circulated our earnings presentation, which is available on our website as well as on the stock exchange's website. I hope you all have had the opportunity to go through the presentation and would be happy to take any question afterwards. This is the second time we are interacting on a quarterly earnings call, and there are many participants who have joined us for the first time. I would like to quickly reiterate our business model for their understanding and then move to discuss the company's recent performance. At Krsnaa Diagnostics, we started our journey in 2011 with a modest 2 radiology centers, and today we are operating 1,900 plus diagnostic centers in 14 states, emerging as one of the fastest growing and differentiated diagnostic service providers in India. We are the only listed player in India providing large-scale radiology services through 130 centers and more than 1,300 telereporting centers. Among many important aspects of our business model, the key is public-private partnership, under which we engage and collaborate with central, state governments, municipal corporations to provide diagnostic services at these public hospitals. As per the contract requirements, government hospitals provide us with the required space for setting up the diagnostic centers, and then we install these specified equipments, deploy the required manpower to provide affordable and high-quality diagnostic services. We are also proud to establish best-in-class infrastructure within these government hospitals, starting from the interiors to ensure comfortable and best experience for patients, as well as deploying machines or equipments procured from global OEM vendors like Wipro GE, Siemens, Philips, Fujifilm, etc., to ensure high-quality imaging and accurate reports. The PPP arrangement ensures that we have a large and addressable customer base from day one, given majority of the population today gets treated at most of these government hospitals. In addition, there are multiple cost efficiencies in the operations, such as no need to pay doctor referral fees, limited expenses on promotions, low or no rentals to government hospitals for the space, as well as subsidized utility and electricity rates. In addition to the PPP model, we also have strategic tie-ups with 26 private hospitals present across 2 states. In this model as well, we also enter into a contract with these private hospitals who provide us space in their premises, wherein we set up the radiology and pathology centers on a revenue sharing model. Furthermore, our telereporting hub in Pune, which is one of India's largest radiology reporting hub, at this facility, we have almost more than 190 plus team of radiologists from India and abroad as well, who examine these digital images on a 5 megapixel medical grade monitor and prepare these reports. This is a unique value proposition which addresses the shortage of full-time of doctors and also allows us to serve patients in remote locations where diagnostic facilities are limited. These are some of the underlying fundamental cost advantages that are inbuilt in Krsnaa's business model and are sustainable. We also employ the most advanced technologies with cloud-based support in our centers, ensuring that our patients get seamless and robust evidence-based treatment in any part of the country. With the scale and strength of our business model, Krsnaa is able to offer high-quality services at disruptive prices, with our radiology test almost 45 to 60% lower and the pathology test 40 to 80% lower than the market rates. Even with these disruptive test prices, we are able to deliver higher operating margins when compared to the industry. I hope this information is helpful for the first-time participants. Now moving on to our quarterly results. In the third quarter of the fiscal year, we continued our growth momentum. The company delivered strong performance on both operational and financial aspects. Our test volumes saw an overall increase of 53% year-on-year in Q3 FY22, an impressive growth of 81% year-on-year in the 9 months ended FY22. Overall, business continued to remain resilient with improving COVID-19 situation and favorable macroeconomic factors. Revenue from operations stood at rupees 106 crore, which is an increase of 9% year-on-year. This growth is primarily driven by our core business of radiology and pathology, which grew by 34% year-on-year and was partially offset by a decline of 93% year-on-year in COVID-19 revenues. During the quarter, we continue to focus on our underlying strengths with no dependence on COVID business, along with the overall moderation visible in the industry due to the festive season. In the 9 months ended FY22, we have delivered revenues of rupees 347 crore, a robust growth of 16% year-on-year. Our businesses grew by 85%, while the COVID-19 revenues declined by 71%. Furthermore, it is encouraging to see that within the first 9 months of FY2022, the company has surpassed FY21 numbers in terms of EBITDA and profit after tax. Our CFO, Mr. Pawan, will discuss the financial performance in more details later on. In terms of the business expansion, we have made good progress for the new projects that we had won in the state of Punjab and Himachal Pradesh. For radiology, we have operationalized 5 centers in Punjab and 1 center in Mumbai. For pathology, we have operationalized 5 processing centers and 42 collection centers in the state of Punjab. Construction for 10 radiology centers is already complete and is at different stages for another 14 centers. Overall, the progress remains on track at the end of January 2022, and all these centers are expected to operationalize in the coming months. We are well placed to benefit from the commissioning of these new centers, and equal revenue contribution will be visible in the next fiscal year, and we remain on course to deliver accelerated growth. I would also like to update you on the utilization of IPO proceeds. Out of rupees 146 crores outlined for debt reduction, we have utilized it fully for the repayment of the same. Rupees 151 crores, which were outlined for establishment of diagnostic centers, out of which rupees 39 crores have been incurred for the construction of centers that I just mentioned. Looking ahead, with the Union Budget of 2022 acknowledging accelerated improvement of health infrastructure in the past 2 years, we expect National Health Mission to continue moving forward with an integrated and coordinated approach between the center and states to develop and provide accessible and affordable healthcare services. Furthermore, the company has participated in 3 tenders of states, namely Himachal Pradesh, which is a pathology tender across the state covering 6 medical colleges, 93 civil hospitals, and 90 community health centers. Punjab for 1 MRI, and Uttar Pradesh a radiology tender for 2 clusters of 8 CT scans each. And the results of these tenders are expected soon. Along with this, there are various other tenders published for the states of Assam, Bihar, Rajasthan, and Madhya Pradesh, for which we will be participating in the same. In terms of the private hospital partnerships, we are in advanced discussions with around 5 to 6 hospitals, and hope to conclude on the arrangements by the end of this fiscal. Krsnaa Diagnostics remains at the forefront to closely work with government under the PPP model, and our management team remains fully committed to expand and grow business with a prudent and well-defined growth strategy. Now, I will hand over the call to Mr. Pawan Daga, our Chief Financial Officer, to discuss the financial performance. Over to you, Pawan.
Thank you, Yash. A very good evening to all the attendees. I will present financial highlights of the quarter and the 9 months ended December 2021. In Q3 FY22, company registered revenue of rupees 106 crore and increase of 9% on year-on-year basis from 98 crore in Q3 FY21. Core business comprising of radiology and pathology posted a revenue growth of 34% while COVID revenue declined 93%. Operating EBITDA for the quarter stood at rupees 30 crores, a growth of 48% on year-on-year basis, with the margin improving to 28.6% from 21% in Q3 FY21. Margin improvement is a result of a better revenue growth and a revival of inherent operational efficiencies of a core business as its share increase. Profit after tax for Q3 FY22 was rupees 16 crore, a four-fold increase from Q3 FY with the margin of 14.7%. On a year-to-date basis, the company has registered revenue of rupees 347 crore in 9 months FY22, an increase of 16% on year-on-year basis from rupees 301 crore in 9 months FY21. Operating EBITDA stood at rupees 105 crore, growth of 73% on a year-on-year basis, and margin improving significantly to 30.2% as compared to 20.2% in 9 months FY21. EBITDA margin improvement can be attributed to higher number of tests, increased contribution from core business, and stabilizing the cost of material consumed. In 9 months, PAT was rupees 50 crore, a growth of rupees 215% from rupees 16 crore in 9 months FY21. When adjusted for exceptional items, profit after tax margin were 14.1% as compared to 5.2% in 9 months FY21. Utilization IPO proceeds for debt repayment has resulted in reduced interest cost and also contributed to improvement of a profitability margin. And we are now a debt-free company. I also pleased to share that the company is now rated by ICRA A stable for a long-term borrowing and A1 for short-term borrowing. Our PPP projects implementation in Punjab, Himachal and Mumbai is on track, and so far we have incurred capital expenditure of rupees 39 crore for setting up these new centers. I would also like to take a moment to explain certain costs in detail for the clarity of all the participants. Number 1, for round-the-clock services, our center need minimum 3 personnel. However, at a majority of tele-reporting centers, the technicians are appointed by the government. And due to leveraging of digitizing technology, we need very few resources to manage this center. Number 2, in PPP projects such as Rajasthan, Manipur, Meghalaya, we work with a business partner with whom we have a revenue sharing agreement who provide diagnostic services including required manpower for these services. Number 3, charges paid to 190 plus doctors for reporting are separately reported under reporting charges, which is a part of other expenses and is not included in the employee cost. Number 4, finally, we follow industry benchmark in paying salaries to our staff and don't compromise on the quality. Thank you very much. And now we will be happy to answer any question you have on the company's recent performance or a business model.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Anyone who would like to ask a question, please press star and 1 at this time. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Tushar Sarda from Athena Investments. Please go ahead.
Hello, can you hear me?
Yes, sir, we can hear you.
Yeah. Thank you for the opportunity. I wanted to understand your realization in radiology and pathology segment because it seems that from the presentation you've done more business of radiology and therefore I thought the revenue per patient should have gone up. But actually it seems to have gone down. So if you can give some clarity on this, it would be nice. Thank you.
Sure. So in terms of the realization for radiology and pathology, the reason why, compared to the increase in volume growth, the realization is not in the same trend is because there are certain growth in the volume of the telereporting cases, which are generally priced at, about very low. And that is the reason why you see the realization not in line with the, growth in the volumes of the number of tests. So on an average, typically our realizations for radiology would be around 2,000 rupees or such. But again, with a combination of MRIs and CT scans and the X-ray telereporting, the blended rate would be different.
Okay, I think last time also you mentioned similar things. So is it possible to give this information separately? Because, I mean, if it's only telereporting, why do you include it in the number of tests? Because...
no, because these are also tests, right? So basically we have X-ray telereporting, we have some CT telereporting as well. So these are patients who come and these are serviced at the centers and the doctors do the reporting.
Okay. And are your margins higher in just this reporting business or?
Yes. So telereporting generally involves not significant amount of investment, unlike your standalone centers or the regular centers. Telereporting, basically there are certain equipments like a digitizer that we have to deploy largely for the X-ray centers, which basically helps us expand in these remote locations and also service the patients.
So, I mean, because, you install these machines and also as analysts, we like to look at utilization of the equipment. If you can either include it in the presentation or give this number separately, it would be helpful.
Sure, we'll share these numbers separately.
Okay, thank you. Thank you and all the best.
Thank you.
Thank you. Ladies and gentlemen, in order to ensure that the management will be able to address questions from all participants, we would request you to please limit your question to 2 at a time. Should you have a follow-up question, please rejoin the queue. Thank you. The next question is from the line of Praveen Sahai from Edelweiss Financial Services. Please go ahead.
Yeah, thank you for taking my question. My question is again on the realization front. On the sequential basis as well, if I look at your realization is down on the overall basis, whether it's per patient or whether it's per test. So, as you had mentioned that the radiology account for some tele-reporting and all. So even in the sequential basis, your radiology realization has down, or the COVID has a significant down in the realization. What exactly happened of 12% of a degrowth on sequential basis?
So the realization that you see is down, as I mentioned earlier, is because of certain volume of tests which are priced lower. However, if you see in the overall volumes that we do, because we also have a large tele-reporting presence, and most importantly, one of the reasons why the realization is down is also because of the fact that in the previous quarters, there were various tests which were linked to COVID, which were high-priced tests, whereas now these are your routine, regular tests that the company has been doing year on year, assuming now these are the normalized numbers. So this is how we see, and we don't expect a further downward trend in terms of realization, because the two facts, one of this quarter 3 is generally where, because of the festive season, people generally prefer only these regular tests. And at the same time, most of the tests which were earlier required for COVID, like if I give you from a lab example, the ferritin or IL-6 tests, these are no longer there, and these are steady state or routine tests like CBC and thyroid, which also has resulted into lower realization. But these are our steady state volumes, and we don't expect further downward trend in terms of these realizations, as well as in terms of radiology as well. There were certain tests like HRCT, which was again priced higher, but now because COVID numbers have reduced, the HRCT volumes have also come down, and hence you now see steady state realizations, typically for our business, where, as we mentioned earlier, our prices are almost 40 to 50% lower than the industry rates or the market rate.
Okay. And the second question is there any contribution in this quarter from the Punjab?
No, as of now, there is no revenue contribution from Punjab. Very nominal numbers.
It's a minimal number from the Punjab, which is contributed in quarter 3.
So from the fourth quarter onwards, we will see contributions, significant contribution from Punjab.
No, so Punjab, as the centers are ramping up, we should see, some sizable contribution coming from the Q1 of FY23.
Yes. So I'll come in the queue. Thank you.
Thank you. The next question is from the line of Divesh Shumalan from DS Investments. Please go ahead.
Yeah, hi team. Good evening. Just wanted to get your thought process on, so if I were to take the current quarterly run rate, which is about 100 odd crore, and has been the case for Q2 as well for us, right? If I were to take a step up and go to FY23 when Punjab and Himachal and Mumbai come online, what is the, I know there would be a steady state which might take time, but what would be the jump that we can expect in terms of revenue from these 3 major wins? That's my first question.
So with these various projects getting operationalized and on a steady state revenues, we expect the jump to be anywhere between 30 to 50% growth in the coming quarters, and that is what we are hopeful and confident of achieving.
So that would be about 130 to 140, 50 crore type run rate a quarter when they start maturing. Is that
yes? So on a full annualized revenue, we would expect around 100 or plus crores revenue coming from these new projects.
Okay, good. And if I were to little bit zoom out and look at 2-3 years down the line, because there would be many tenders that you would go and keep bidding. If you were to look at little longer horizon and do a modeling, how would you want us to look at the pipeline? Because I know you called out qualitatively that there are a number of tenders in pipeline, but if we were to look at little longer, I'm sure you must be tracking internally the tenders and all. Would there be a way to sort of give us some hint about how does the pipeline look in terms of quality and quantity?
Sure. So if you consider, this is something that we've been talking earlier as well. First of all, the government has earmarked 64,000 crore under the National Healthcare Infrastructure Mission, wherein government has ambitious plans of upgrading each district hospital most of them converting into medical colleges or upgrade the facilities there. What Krsnaa has acquired in terms of these projects, in our opinion, it is just tip of the iceberg, given that we are present in probably around 70 plus districts, whereas there are 760 districts in the country. So from an opportunity perspective, I think there are many more states which are opening up in terms of looking at this PPP model, which has been successfully been running for so many years. And I think COVID has amplified the need, where government has also seen that, and they want to upgrade the healthcare infrastructure in the country. So this is where we see, growth coming up, and more states are also going deeper. When I say, for example, Himachal Pradesh, where we've been doing CT scans, they also launched the tender for pathology. So likewise, other states, when they have tasted for a particular, let's say, whether it's a radiology or pathology, they are also now exploring other verticals where they want to make these facilities available to the masses. And I think that's where we also see an additional opportunity for us. Beyond this, as we mentioned, we're also equally looking on the private hospital or the private side of the business, where we will be looking to set up our own kind of network, or leveraging the network that we already have in these 14 states to set up collection centers and processing labs, where we can also augment these additional lines of revenue.
Got it. Thank you. And two quick technical parts. If you can help us understand whether the private partnership margin profile would be similar to what you have in PPP. And the second would be that, I think that's about it. Yeah.
Okay. So the private hospital partnerships, the margins are more or less same. So generally at a company level, we follow the, certain EBITDA thresholds or margin thresholds. However, if I have to compare on a PPP basis, the margins would be slightly, a few basis points lower, because on the private hospital partnerships, you have, certain expenses like the electricity and the revenue share, which is also to be given. However, I wouldn't say it's a significant difference in terms of margins, probably a few basis points here and there.
So great. And one last, if I can squeeze in, how are you seeing the competitive intensity given high margins that we have in PPP and current and the future trends? I know our win ratio has been great, but just wanted to get some thoughts from you.
So, of course, we are seeing competition, but as I said, if you see from a landscape perspective, the landscape is pretty huge. We are seeing even, listed players coming and participating in these tenders. But again, we've not seen a very active participation. They are, we've seen them come participate in few tenders. But I think directionally, what we believe is, given that they already have established a good business model, a good market that they, have covered, and entering into the government business and pricing the same test at such low rates, in our opinion, and what we normally hear is, could impact their existing pricing, and that's how we see these competition generally not playing an active role. But of course, there are other players also, regional players, who come and participate in these tenders.
Okay, thank you. Thanks a lot.
Also, there is an government also looking for a serious player who participate for the project to provide the service to the nation or the people, citizen of the state or citizen of a nation.
Got it. Thank you.
Thank you. The next question is from the line of Deepak Poddar from Sapphire Capital. Please go ahead.
Yeah, thank you very much, sir, for the opportunity. So I just wanted to understand, in the previous call as well, we were kind of talking about 700 crores kind of a top line next year. So that's what we are kind of targeting, because the 30 to 50% growth in revenue gives a run rate of 135 to 150 crores. That would be closer to a 550 to 600 crores kind of a top line.
So I think normally from a growth perspective.
Members of the management, we cannot hear you.
Yeah, sorry. Just 1 second. Yeah, sorry. So basically, if you see in terms of the growth that we are, expecting for the next fiscal, is around 650 crores is what we have. So if you see currently we are doing around, with the current run rate, and the new projects coming up, we expect revenue in the range of around 650 odd crores as a top line for the next fiscal. So that comes to around 45% in terms of growth. But of course, given that businesses are dynamic, we've given a range of around 35 to 50% in terms of expectations for the next year.
Understood. So understood this point. And on the EBITDA margin, so how do you see the operating leverage playing out? Because at a higher revenue scale, currently we're at about 29-30%. So any comments on the operating leverage advantage that we can get at a higher revenue base?
So of course, as we mentioned earlier as well, as the business will continue to grow, and since certain of these costs are already absorbed, every additional revenue will start contributing to better EBITDA. The only thing is, from a project implementation perspective, because Punjab and other centers are getting operationalized, so in the initial couple of months, the EBITDA will be a bit, subdued because of the revenue not matching with. But I think over the years, if you ask me, yes, there will certainly be an improvement in the EBITDA and margin going forward, because our fixed costs have already been absorbed, and as we go along, every additional revenue will start contributing and adding more to the EBITDA and PAT.
So improvement over this 30% on.
Yes.
That's it from my side. All the very best. Thank you.
Thank you. The next question is from the line of Sai Kumar Venkat, an individual investor. Please go ahead.
Yeah. Hello, sir. I'm Sai Kumar. I'm an individual investor. You can hear me, right?
Yes, we can hear you.
Okay, yeah. I'm really happy to be present here and ask a question, sir. And thanks for picking up my question. So I know that we do partnership with the public hospitals to set up diagnostic centers in the premises of the hospital. So in such cases, I have two questions actually. So the first question is, do we just cater for patients who visit the public hospital itself, or we also see some organic visits?
Sorry, could you just repeat the last part of the question?
Yeah. Do we also see any organic visits? I mean, any patient from other than that public premises hospital?
Yes, of course. So basically, when we set up these centers in public hospitals, there's no discrimination between public patient versus a private patient. In fact, in some of our centers in metros, we have almost 30 to 50% of private walk-ins. These are your everyday people, whether it is people from IT industry or even in some cases we have HNIs coming to the centers. So we certainly see this, and that's the reason why from day one as a model, we've invested in quality centers, in utilizing quality equipment, best-in-class infrastructure to ensure that every patient who walks into our centers get these high-quality services at these highly disruptive prices.
Nice. Thank you, sir. My second question is simply about why our average revenue per test is getting down, sir?
So as I mentioned earlier, the reason why you see a drop in the average revenue compared to the previous quarters is also because of the fact of the test mix. So in the previous quarters, there were various tests which were, high priced, like for example, which are COVID related, like your special test, IL-6, ferritin. Whereas now you see the routine regular test, which currently is part of the existing revenues. And these are the steady state, volumes and tests that we see. And we don't expect a further, erosion or downward trend in our prices, because these are steady state prices that we've been seeing even in the pre-COVID times.
Okay. Thank you. All the very best, sir, for the whole team.
Thank you.
Thank you. The next question is from the line of Agraj Shah from Tata AIA Life Insurance. Please go ahead.
Thanks for taking my question. So recently I've seen ads of Ajaxam, which is your packaged health testing packages. So could you go segment?
Sorry to interrupt you, Mr. Shah. Your voice is breaking up. Can you please check your line?
Hello, am I audible now?
Yes, this is better. Please repeat your question.
Okay. So I've recently come across the ads on various social media sites on Ajaxam health packages. So can you just take me through that, again, what this package is and which segments are you targeting, etc.?
Yeah. So these packages that we have launched, as you mentioned, currently we are also trying to foray into the private market, and that is the reason why we have built up these packages, where these will be for home collection services, for corporate. So we have built this, and soon these will also be launched across all the states across the country.
This will be for existing participants who come to your centers, or this will be another? Yes. Okay.
Yeah. So this is in work in progress. As we, once we officially launch this, these will be made available to everyone who has come in. Currently, these are, as we are saying, we are also testing how these packages are being received by the customers, and then we'll officially launch this across various states, wherever we have a presence.
Okay. And secondly, with doctor consultations actually going online and diagnostics actually participating in that, do we see a case for probably the gap is on the radiology side, etc., where there are no other players at least competing in that space? Is there a business case for us to actually participate in that part of the teleconsultation business?
So, if you see currently the way our model is built upon, we already have a large teleradiology reporting hub, wherein we, though we are serving our existing centers, of course, in terms of capabilities and capacities, we do have to even serve other so-called centers, and there are some discussions going on. But as of now, given these volumes that we are processing, I think we have enough on our plate, and we will certainly be exploring these options as we go along.
Okay. And lastly, on the new center that you said that the EBITDA will be hit at least in the FY23. What kind of given that on the overall scheme of things, how much dilution will see on your EBITDA for the next couple of years from the new centers? And given that, I guess our understanding is that these centers ramp up quickly within 1 to 2 years. So what would be the drag for the next couple of years?
So in terms of EBITDA, we will be maintaining the existing level of EBITDA. We don't see a downward trend. In fact, they should be improving. So even with the combination of the new centers and our existing centers ramping up, the EBITDA trend should be at least the same, or at the best it will be improving. We don't expect.
So you're talking about margin, right? Not the absolute number.
Could you repeat the question, please?
So you're talking about the margin trend, right, or the absolute EBITDA?
EBITDA margin trend, yes. It will be consistent margins in terms of, and there will be, in our opinion, it should be moving up at least between 3 to 5% in the next fiscal and going forward thereon.
Okay, so basically this 29-30% would at least be the case, and anything that comes will be on top of that as you build scale over there.
Yes.
Got it. Thank you and all the best.
Thank you.
Thank you. The next question is from the line of Siddharth Agarwal from Prudent Capital. Please go ahead.
Hi, good afternoon, sir. Thank you for giving the opportunity. So my first question is, sir, ours is a capital-intensive business with both, upfront capex as well as high working capital. So what do you think is the long-term sustainable ROC for this business?
So, whilst it is, of course, capital intensive when you consider the radiology part of the business, but like we mentioned in our earlier calls as well, if you see these centers, given the volumes and the prices that we offer, we are able to generate a good amount of revenues on the capex that we deploy. And we've seen most of our centers, providing ROCs north of 15% plus, even for radiology or centers. So, of course, going forward, as the centers start maturing and with a combination of the pathology projects as well, the ROCs at a company level will also continue to improve. And we're confident about that, given that we've already seen the same in few of our various projects, whether it is Karnataka or other Himachal projects. So, in spite of radiology, I think the ROCs are much better, and we've been able to successfully demonstrate that year on year.
Okay. And sir, as a private company, we have had a history of a very fast growth, which was aided by high levels of debt. Now, as a listed company, how could you talk a little bit more about your capital allocation, as in how much debt are you comfortable running with, and what is a sustainable growth that the company can achieve without diluting further? Or are there plans to dilute further again, to fast track the growth?
Sure. So in terms of, as I mentioned earlier, we are already a debt-free company. And, as a philosophy, we would like to maintain to be a debt-free company. Now, in terms of expansion of new projects or new tenders that come in, we don't expect to dilute any further. Based on the internal accruals that we'll be generating and with a combination of creative vendor financing, for which we are already in discussions with various OEM vendors, we believe that we could still continue to expand and grab these projects without any further dilution of the company. So I think a combination of our internal accruals and at the same time having significant cash in the books as well, we can still continue to expand. Given that we've reached this scale and size now, where many OEM vendors are willing to extend their line of credit, as at the same time our internal accruals are good enough for us to allow us the expansion in the subsequent years.
So, sir, in coming years now, then we can see 100 crores sort of a cash flow coming in every year, right? Once our Punjab centers, etc. stabilize.
Yes. So if you take, just even if you have to consider on a very conservative note, if you take a 600 crore top line also with a 30% EBITDA, that's almost 180 crores of EBITDA. So these are the internal accruals that we are expecting in the subsequent years on a steady state, which will be generating year on year.
Okay. Great, sir. Thanks a lot for your questions. I'll get back in with you.
Sure. Thank you.
Thank you. The next question is from the line of Krish Mehta from Enam Holdings. Please go ahead.
Hi, thank you for taking my questions. The first question I had was on your accounts receivable days for the quarter. If you could give that number.
Could you just repeat the question, please?
If you could give the accounts receivable days for the quarter.
The account receivable days for this quarter would be around 71 days. Yeah.
Okay, and my second question was on your vendor financing. What % of your finance cost for the quarter was vendor financing?
I think the percentage cost would be very minimal in this quarter.
Okay, thank you so much.
Thank you. The next question is from the line of Manoj Dua from Geometric. Please go ahead.
Good evening, sir, and thank you for providing good service to the nation at affordable price. My first question is, now with the new centers coming, we will get a bump up in the sales. So how to think forward of FY24 from these new centers? How to think in terms of capacity utilization? I know it's not a manufacturing industry. Even with this 50 crore or 200 crore coming from these centers, can it be 300, 350? How to take a major part from these centers can come, which we are implementing in this quarter and next quarter? Thank you. That's my first question.
Sure. So in terms of capacity utilization, if I have to give you, as a roadmap, typically if you see, once we establish, a radiology center, we start doing, say, on an average 25 cases on a monthly basis, which ramps up to 40. And there's a potential to go up to 60 and even higher. So all this depends on, once the people of these respective geographies start getting to know that these are the tests available at highly disruptive prices, we see more and more footfalls coming into our centers. So, of course, in the subsequent years, I think FY23, 24 onwards, as the centers start maturing, we expect the revenue contribution from the existing centers to go up, and they should further help us in augmenting our revenues along with these new centers that will also come along. So there is no limitation per se in terms of how much can be expected in terms of growth. Of course, for the theoretical capacity, even in some of our centers in metros, we've seen such centers, given that they are at so disruptive prices, they do significant volumes.
Okay. Can we expect 7 to 8% growth from mature centers in a steady basis because of increased test value or something? I'm not putting this inflation which we get from government because of the cost also get in that area. just because per value test increasing and number of tests increasing comes through efficiency, etc. Can you put some growth to that?
Yeah, in our opinion, 10% is a steady state growth that we expect from our existing centers year on year.
Okay. Can you throw some light on the vendor financing? At what cost normally you can get from there?
So the vendor financing that we are currently working on would be in the range of between 7 to 8%. I think max around 9% is what we are working out, and that should be materializing very soon.
Okay. With very stable cash flows, very predictable cash flows also, as in the centers has 600 crores, 50 crore sales, why a company would be wanted to be debt free if the growth paths are so high? Why a company won't be able to use some debt to utilize and make it more large scale benefit of economic of scale and remain relevant in disruption pricing?
So there are two reasons. One is, of course, the way we have grown and matured at this stage, and when you have the option of creative financing from these vendors where they also have a skin in the game. So I think that's the first approach we would prefer to choose. Of course, if there's a large project which gives us a long-term or visibility in terms of revenue, and it makes sense to go using a combination of debt and our equity, we'll of course evaluate those options. But as a philosophy, we want to be a debt-free so that we use optimum use of capital wherever, whether it is vendor financing or debt. We will of course evaluate those options at that point in time, considering the project that is on hand, and we can certainly take those decisions.
Okay, thank you. I'll join back in queue for more questions.
Sure, thank you.
Thank you. The next question is from the line of Parth Dalia from DAM Capital Advisors. Please go ahead.
Hi, thanks for taking the question. Could you help me out with the capex guidance for the current financial year and FY23?
So the capex guidance for the current financial year is only restricted to the project that we had won, which was also mentioned in the RHP, which is basically Punjab, Maharashtra, and Karnataka and Himachal Pradesh. For the next fiscal, given that these tenders are in the pipeline, we would expect around 100 crores of investment that we believe would come our way, given these tenders which are there in the pipeline. So around 100 crores is what we expect in terms of capex for the next fiscal.
Okay, got it. And for FY22?
Sorry, for?
This year?
This year, nothing except for the project that are already won and we are currently implementing. So no additional capex in this fiscal.
Okay, thank you. My second question is on the pricing trend per test on pathology and radiology post recent addition of contracts. Are we observing any pricing pressure for newer contracts?
No. So, at Krsnaa, we generally don't follow a pricing pressure. We'll only go for a particular project or a tender if it, makes sense, both in terms of a strategic, approach to a particular state if we get an entry there, and largely it is driven by certain, EBITDA and metrics that we have. We just don't take any tender because of pricing pressure.
Okay. And did we take any price hikes this year for our existing business?
Yes. So wherever these prices which are either part of the contract, and that is one of the features where we have, whilst we see from a realization rate the prices are low, but we don't have any pricing revision or downward pricing pressure for our existing rate card because these prices are already part of the embedded part of the contract. In fact, there's a price escalation clauses in most of our contracts which allows us to increase the prices. So from that perspective, we don't see any downward revision or pressure on the prices. And in fact, there have been certain tenders that in the past also we have won, which were higher than the previous prices at which we were operating.
Okay, that's helpful. And lastly, could you help me out with the price hike outlook for the newer contracts going forward?
So there is no definite price hike. It all depends on the tender, the investment that is required. But just to give you some kind of anecdote here, like in more previous tenders for a CT scan, the average rate used to be 1,200, but when we bid for Karnataka, we bid at 1,550. So it all depends on the project. The X-ray tele-reporting project that we were doing for AP, which was initially at 33 rupees, when we re-tendered, we bid it for 62 rupees, and we are currently operating at 62 rupees. So the prices generally are determined based on the project, but they are normally benchmarked to the CGHS rates.
Got it. That's all from my side. Thank you so much.
Thank you.
Thank you. The next question is from the line of Manoj Dua from Geometric. Please go ahead.
Sir, as you told that you have some barometers for bidding, some EBITDA margin, or unless it is a very strategic decision, you don't bid for the tenders with a lower margin or lower ROC metrics of yours. Are you finding any reasons, like more instance increasing, where you are not bidding because your metrics are not met, or you are able to bid easily as of now? What is the situation now?
No, so basically when it comes to pricing the bids, there is no restriction for us not to participate. We will participate and quote the prices based on the threshold that we have determined. Now, the winning would be dependent on what the competition might quote. There have been instances in the past where competition would have quoted lower, but as again they've realized that they were not able to do it successfully, and these tenders have also come up and open for re-tendering again, because these bidders are not able to successfully take it through. So that's the reason why we are really not concerned in terms of pricing pressure. We know how to run this business, at what prices it is basically feasible to take up a project, and that is only how we will consider pricing for these projects going forward as well.
Yes, thank you. Can you throw some light on the B2C you are trying to going forward experiment? If it is not too early, you can leave it as an experiment stage. And my second question is how you are seeing B2B growing forward in the future. Would the present mix of B2B and B2B will remain same, or this private hospital percentage share is going to increase in the future?
Sure. So as regards to the B2C, we are working on certain models in terms of expanding and leveraging our existing network. It's basically, setting up collection centers. So currently this is in works, and we should be announcing it soon, probably by beginning of the next fiscal. As regards to the private hospital shares, we are continuing to expand our footprint, reaching out to hospitals, and equally we are also seeing interest from various hospitals who have started approaching us. So we would want to continue that approach, and even optically, number-wise as well, it's a healthy number to have 50-50, in terms of 50% revenue coming from the PPP side and 50% coming from the private side. So we are working in that direction as well.
Okay. My last question, as you said, you will expand through vendor financing and the internal accrual. Leaving this FY23-24, where there could be a little bit higher bump due to new projects we won. Can we grow 22% extra for some longer period, like 4 or 5 years from this strategy? And with the opportunity available, can we take a minimum 20% growth going forward from FY24 also?
Could you just repeat the question again? Your voice is not very clear.
My question is, this FY23 would be a good bump up because of the recent orders we won, and maybe FY24 maybe some jump spill up come over from the new orders which we won. But with the internal accruals and vendor financing, can we be confident we can grow 20% without dilution for a 4 or 5 period of time continuously?
Yeah, I think there's no doubt on this. We can, with this model, we can certainly expand and grow 100%.
By 20% minimum. This is my question.
Yes.
Okay. Thank you and best of luck.
Thank you.
Thank you. The next question is from the line of Siddharth Agarwal from Prudent Capital. Please go ahead.
Hi, good afternoon, sir. Sir, just in follow-up to the previous participants' questions, what you answered. So, what are the risks if any, which can prevent you from growing at 20% and, for a, for midterm, we are talking about, 5-6 years at least. So what could be some of the risks which could prevent you from doing that, if any you foresee?
So, if you see in terms of the current business model, we are setting up diagnostic centers in areas or region where there is very limited access to quality diagnostics. As people are becoming more and more aware of the requirement for diagnostic tests, as well as the government has also realized. We start at the lowest prices and there's a price escalation built into it. Secondly, these are long-term contracts with 10 plus years. Thirdly, there are enough opportunities for many states to open up and use this PPP model. So we provide the best-in-class equipment and best-in-class services. So if you see all these factors, if you consider, we don't see any risk that will come our way in terms of expanding and continuing the growth trajectory that we've had. Of course, there is competition, which is and people are looking at this space. But I think, given the overall opportunity that is existing today, even if competition comes, I think we believe, and as I mentioned earlier, we believe this is a healthy. It establishes a healthy market and any significant risk going ahead.
Great. And sir, is there any center that we have lost, where our term came for renewal, and for whatever reason we could not won the rebate and we have lost it?
As of now, there is no such project which we have lost. Whatever came for re-tendering, we have won it and we are continuing to serve it.
Okay. Great. And sir, lastly, sir, in B2C, you mentioned in one of the earlier answers, you mentioned that we are also planning to provide diagnostic packages to private clients also. So is there anything in our our PPP contracts which prevents us from using the government facilities for catering to private business? Is there any constraint as such that we have to first give preference to the patients walking into the hospitals, etc.?
See, basically the reason why government wants to upgrade this facility is they want to provide services to the masses. Now, government does not discriminate between a private patient or a government patient. For them, it is a citizen of the state or the citizen of the country. So as such, there is no discrimination. Of course, there are people, let's say, who are under certain schemes. They have to fill certain documents and for which there's a queue. But apart from this, we don't see any such restrictions or limitations, and hence, from our perspective, we don't see any challenges in attending or providing services to these private cases. And in fact, as I mentioned earlier, in some of our centers in metros, we even see a 30 to 50% share of private walk-ins who come in, and the government is also aware of them, and they are happy to continue, because at the end of the day, it's the government's name that gets publicized.
Okay. And the pricing remains the same for a private walk-in or for someone which government pays?
Correct. The rates are same. In fact, for government, they are more happy because they can go and announce that these are the facilities that they've made available to the citizens of that state or municipality or the country. So governments are actually welcoming this if they see more and more patients coming into the center.
So in a way, we'll slowly get into the turf of other big private diagnostics, whether it is Dr. Lal, etc. So in a way, we will start competing with them slowly, while they are not interested in competing with us. Is that understanding correct?
Ladies and gentlemen, we lost the line for the management. Request you to please continue to hold while we join them back to the conference. Ladies and gentlemen, please hold the lines while we reconnect the management. Ladies and gentlemen, we have the line for the management reconnected. Over to you, sir.
Hi. Yeah. Sorry, we got disconnected. So I was just confirming that, with this new B2C initiatives where we are doing these diagnostic packages for private walk-ins, etc. So in a way, we are entering the turf of leading diagnostic players like Dr. Lal, while these players cannot directly compete with us.
No, I wouldn't say we are entering, we're already there. As I said, in most of the places where we are, people are coming to our centers, whether it is the government or, these people from lower income families, as well as people from affluent backgrounds, they're coming and availing these tests. Because for these patients, if the center look and feel ambience is as good as any other private center, the rates are disruptive, the equipment is the same world-class equipment, and the services are the same provided by these, doctors whom we employ. So for them, a 50% price reduction is a significant advantage, even if they have to use a cab to come and, let's say, avail the services. So we are seeing that, and that is where we believe that, with more awareness and with people understanding, and when they come to our centers, they generally do a lot of mouth-to-mouth publicity, which helps us get more and more customers in the years to come.
Sir,
and also, most of these other players are not focused. Most of the other players, they are predominantly pathology focused, whereas Krsnaa is an integrated diagnostics provider, having radiology and as well as pathology as its verticals of revenue and services.
Okay. And sir, what is our equipment like? Over what period do we depreciate it?
So typically these equipment are normally depreciated over their useful life following the accounting standards, and these life of these equipment is generally long. Typically on the radiology side, it is anywhere between 10 to 13 years, depending on the type of the equipment.
Okay, great, sir. Thank you very much.
Thank you.
Thank you. Ladies and gentlemen, due to time constraints, that was the last question for today. I now hand the conference over to the management for closing comments. Members of the management, you may go ahead with the closing comments,
Sure.
please.
Yeah. Hi. To everyone for joining our 9 months ended FY 2022 earnings call. I hope we have answered all your questions, and thank you for being patient with us. Please feel free to connect with our investor relationship team if you have any questions or which are remain unanswered. Thank you very much, and wishing you everyone a good evening ahead.
Thank you. On behalf of DAM Capital Advisors Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your line.